What's up, you guys? I'm Dan. This is Frugal Not Cheap, and today we'll look at the question, should I invest in international stocks in my portfolio? In a recent video, I explained why, despite being a professional trader, that's my day job, I'm a commodities trader, I don't mess around with actively managed mutual funds nor trying to pick stocks on my own. Instead, what I do is invest in broad total stock market capitalization weighted index funds for a variety of reasons. Check the video out to learn more. In that video, I talked about how the S&P 500 index handily beat a number of hedge funds in a bet that was very famous, made by legendary investor Warren Buffett. I might make a future video explaining why I don't invest in just the S&P 500, and I prefer to have a broader total stock market index for the US. But today's video addresses the question about non-US or international stocks. Should I own those? Before I make the case for international equities, and by the way, I should say that of course every situation is different. This is not personalized investment advice. I'm just telling you my thinking and what I do in my own portfolio. And before we look at the case for international stocks, let's look at the case for US only stocks, because there are a few reasons. Even Jack Bogle himself was pretty US-centric in terms of his advice and his thinking. And again, that bet made by Warren Buffett was using the S&P 500 and not a global stock market index. In any case, the first reason would be a home country bias. And we might choose to have a home country bias for many reasons, including familiarity. We're more familiar with the companies that are traded here in our own country. There's also no currency risk, so that's another benefit. Don't have to worry about that. And then also transactions costs and taxes may be lower as well, particularly true if you're in the US. Finally, there could be some simple kind of cognitive bias. It just feels a little bit more comfortable to have more assets invested in the country that you're from or living in. The next reason pertains a lot more to the United States in particular, or maybe some similar countries as well. But I'd say American exceptionalism. Really just the idea that the institutions in America are relatively strong. There's really, really good financial market depth, something that you really only see here and then maybe in Japan and in the UK as well. And then, of course, the rule of law and relative geopolitical stability, all these kinds of things are good reasons why one might want to choose to invest in the United States of America. And then you can apply that kind of thinking to varying degrees on other countries as well. And then finally, we have historical returns. US stocks have far outperformed international equities since around 2008, which is quite a long time. However, there are some strong reasons to consider international equities still, not least of those being performance chasing. So just because the US has performed so well since over the last couple of decades doesn't mean it will continue to do so. But anyway, let's dive into more detail on some of the reasons that I consider in terms of my personal portfolio allocation. So number one, and probably the most important one for me, is diversification. Yes, while the United States has been the dominant power for a very long time, huge country, massive population, huge economy, all this stuff, I would still like to not have all my eggs in just this one country's basket. There are many other countries out there, so it is worthwhile for me, in order to diversify, have a little bit of my risk spread out, rather than again having all my eggs in this one US basket. Second is historical performance. So while the US has outperformed in recent times, this is really something that is off and on. It's a cyclical phenomenon. Looking further back, I think this is kind of a cool chart from JP Morgan that shows that cyclical nature of it. All of the purple areas indicate outperformance from international markets, and it let us know how much it is over that particular period before it flips. And then the gray periods are times of US outperformance. So you can see lots of gray since around 2008, 2009 forward. But we had international outperformance in the early and late 70s, and then massive outperformance during the 80s as well. There, for a period of 5.6 years, we saw a total outperformance of international equities of nearly 300%, and that would be a real shame to have missed out on. And then we also had some pretty solid outperformance in the early 2000s. That was 65% over a period of 7.2 years. Not only that, but actually as of this filming, international stocks were outperforming US stocks year to date. Comparing Vanguard's total US stock market index to their total international stock market index, we saw that as of this filming, the US stocks had actually fallen by 3.45%, whereas international stocks had gained 9.42% year to date. Pretty good outperformance. No one has a crystal ball, but looking further out, Vanguard does expect that international equities will outperform US stocks over the next 10 years. They give a few reasons. One of those is foreign exchange, then also dividend yields, and finally just an expansion in valuations as well. And that leads me to my third point, which is relative valuations. One of the many dimensions to analyze a stock with is what's called the price-earnings ratio. Basically, what is the currently traded price against how much that company is earning. And then, of course, you can aggregate these figures for a stock market index as well. As of this filming, VTI, the US Total Stock Market Index, had a price-earnings ratio of 25 and a cyclically adjusted price-earnings ratio of 34. That's quite high compared to 14 and 17 respectively for the International Stock Market Index from Vanguard. This means that US stocks are relatively valued quite highly against international stocks. And again, no one has a crystal ball, but this could mean that US stocks are a little bit overvalued right now. Or another way to look at it could be that international stocks are a bit undervalued and might be the better sort of value bet. Again, no one knows what's going to happen in the future though. At one point, I chose to have a 50-50 US international stock allocation. At that time, I was feeling a little bit more bearish about the US prospects, I guess, and I was phenomenally wrong about that. And so since that time, what I've done is kind of gone back to my roots. So I have another video about my investment philosophy, but the basic idea behind it is the basic idea that's behind index funds in general, and market capitalization weighted index funds, and that is that the market over the long run will do a better job than I ever could in allocating capital. So I'm applying this basic theory to my US versus international market share in my portfolio, basically looking at the global market capitalization, how much is the US, how much is international, and using that as a baseline, and then making a small tweak. So this may or may not be foolish, but I just can't help myself. Looking at those price-earnings ratios and the discrepancy between the two, I am making a small tweak where I will adjust plus or minus 5 percentage points in that, that ratio between US and international in order to account for that sort of relative higher valuation in the US market against international, or the relative value that international could represent. In other words, right now, whereas the US market is something more like 65% of the global market cap, I'm using a 60% ratio in my portfolio instead. So that's my thinking. Hopefully that's helpful for you in thinking about your own portfolios. Do you guys have international equities, or are you fully focused on your home country? What are the reasons for it? Let us know in the comments below. Hope you enjoyed today's video. If you did, please hit the like button and consider subscribing. Thank you very much for watching, and I'll see you in the next video.